so the topic is there a merit in do-it-yourself way of managing money? Let's talk about that. You know, there is always confusion around products. So we have a lot of products in the product space. Let's list some of them. We have a lot of government-backed products, EPF, PPF, Sukanya Samriddhi Scheme, Senior Citizen Savings Scheme. We have low-cost products like exchange-traded funds, direct plans of mutual fund investments, National Pension Scheme. We have stocks-based PMS. We also have structured products with complex risk and reward games. All these products in the market really confuse the hell out of us to identify which are the right ones which will help us grow our money and help us achieve our financial goals. And I know there are a lot of low-cost or zero-cost products as well in the market which can really help you achieve a lot of money in a significant amount of time and even in a faster way so that you can achieve your financial goals faster. Now, what happens is, in the given landscape, because of the choices we have, we end up having wrong products in our portfolio. We end up choosing products not on the basis of our risk tolerance, not on the basis of horizon that we have for the financial goals, but we end up adding products in our portfolio based on the hearsay, based on what our friends are doing, based on what our relatives are doing, what our colleagues are doing, or what people are coming and selling to us at our doorsteps. So DIY leads to a lot of advantages as well as disadvantages. So let me first talk about the advantages of DIY. You know, if you are fond of keeping only simple products in your portfolio, if you are fond of, you know, keeping yourself up to date with all the money changes, all the financial landscape changes around you, if you are fond of reading the products in detail, if you are comfortable with understanding the products, then you can go DIY. If you have the patience, if you understand the investment methodology, the investment psychology, do it yourself. If you want to keep the cost of managing your money low, do it yourself. If you have an external person who is objectively reviewing your money decisions, do it yourself. If you have the right investor behavior, you understand the money psychology, you understand the benefits and adverse consequences of your decisions, go ahead, do it yourself. If you are aware of all the changing landscape, how the taxes are impacting your financial decisions, how the taxes are impacting your accumulation of money in the compounding way, do it yourself. But remember one thing, we all are human beings, we all end up doing mistakes. So as long as we are learning from our mistakes, as long as we are validating the decisions that we are taking with somebody who is external to us, it will be very, very, very beneficial for all of us. Now, here's the set of reasons why DIY will not help you, right? If managing money scares you, a lot of women come to me and say, I don't understand the alpha, beta, gamma of the market. I just want this money to be growing and working for me. If managing money scares you, do not do it yourself. If you're too occupied to manage your money, if you're too busy in your job or in your business, or if you're too concerned about the time it takes to manage money, don't do it yourself. It's worth paying the money and get it managed externally. If you do not have a good understanding of what your money personality is, we touched upon money behavior in the previous session that Rajiv was doing with Madhu, where we said we all get into buying products when the markets are doing well and we all start exiting when the markets are doing bad. You know, if you understand your money personality and you have the nerve to hold on to your investments, or you don't have the nerve to hold on to your investments, don't do it yourself. If life is throwing too many changes, you know, if there is too much transition happening in your life, you're quitting your job to start your venture, you're buying a property to start something to create a passive income, your wife is leaving a job, your wife is starting a business, there's too much happening in your life, don't do it yourself. You better have it managed externally by somebody who's a professional in helping you manage the money. If you can't keep pace with the changing landscape, right? Long-term capital gains tax came last year. Indexation benefit was withdrawn last year. or any other changes in real estate last year and this year, if you're not able to keep pace with these changes, do not manage money yourself. If fulfillment of goals is more important to you than managing money, please do not do it yourself. Please have an expert validate your financial goals plan. Have him look at it objectively and help you achieve your goals. If you don't understand the big picture about your money life, don't do it yourself. So there are a lot of reasons where you will be tempted to do it yourself, and there are a lot of reasons where you should not be doing it yourself, because at the end of the day, it's your hard-earned money, and the last thing you want to do is doing some stupid mistake and losing the money that you have painstakingly accumulated till date. We have tons of opportunities. You know, we have a lot of these B2C platforms which are offering direct plans and ETF, and you can manage your money yourself. But you make sure that you have a human intervention in your process of managing money, because the external validation is key to helping your money grow. And at the same time, if you are taking an advisor to manage your portfolio, just ensure that the advisor fee model is transparent. You know, the advisor, whether he is making money by earning commissions, or whether the advisor is making money by charging you a flat fee or an hourly consultation fee, or a fee which is linked to the AUM and not at all linked to the commission, please understand the fee model, question the fee model, make sure there is a good balance of money that you're spending in managing your investments, money that you're spending on doing the process, and at the same time, cost that you're minimizing to manage your investments.